When performing an audit, auditors use two key testing methods, compliance tests and substantive tests, to gather evidence and ensure that systems and financial information are reliable. Let's start with compliance tests. These tests check whether an organization is following rules, laws, or internal policies. The goal is to confirm that people are doing what they are supposed to do. Example: in a bank, an auditor might test if employees follow anti-money laundering (AML) rules by reviewing customer identification and transaction monitoring records. Another example: in a hospital, auditors might check if the hospital complies with HIPAA by ensuring patient records are properly secured. Next are substantive tests, which dig deeper into the actual financial data. These tests aim to confirm the accuracy and completeness of what appears in the financial statements. Example: in a manufacturing company, an auditor may verify the inventory balance by physically counting stock and comparing it with accounting records. Another example: when auditing a payroll system, auditors may check random salary payments to ensure they match employee records and timesheets. In simple terms, compliance tests ask, are we following the rules? Substantive tests ask, are the numbers correct? Together, these two testing methods give the auditor confidence that the organization's operations and financial reporting are both compliant and trustworthy. Example: in a manufacturing company, an auditor may verify the inventory balance by physically counting stock and comparing it with accounting records. Another example: when auditing a payroll system, auditors may check random salary payments to ensure they match employee records and timesheets. In simple terms, compliance tests ask, are we following the rules? Substantive tests ask, are the numbers correct? Together, these two testing methods give the auditor confidence that the organization's operations and financial reporting are both compliant and trustworthy. Sampling simply means checking a portion of something to understand the whole. In auditing, it's not practical or necessary to test every single transaction. Instead, auditors pick a small, representative group called a sample. The idea is that if the sample reflects the larger population, the auditor can confidently draw conclusions about the entire set of data. Example 1. Imagine a supermarket processes 10,000 sales transactions in a month. The IS auditor doesn't review all 10,000 receipts. Instead, they might select 200 at random to check whether proper approvals and pricing were followed. Example 2. In a payroll audit, an auditor might test 30 employee salary payments from a list of 2,000 employees to confirm that salaries were calculated correctly and approved by HR. Example 3. In an IT environment, an auditor could sample 50 user accounts from a total of 2,000 to verify that each one has the right level of access. Sampling saves time and cost while still giving auditors enough evidence to make sound judgments. However, the key is to choose a sample that fairly represents the entire population. Otherwise, conclusions could be misleading. In short, sampling helps auditors work smarter, not harder, by focusing effort where it matters most while maintaining confidence in their findings. When auditors select samples, they can use statistical or non-statistical methods. The main difference is how the samples are chosen. Statistical sampling uses math and probability to make sure every item in the population has an equal chance of being picked. This approach helps the auditor measure how confident they can be in their results. Example: in a company with 5,000 vendor payments, an auditor uses computer software to randomly select 100 payments for review. Since every payment had an equal chance of being chosen, the results are unbiased and measurable. This method is reliable but sometimes more time-consuming. Non-statistical sampling, on the other hand, relies on the auditor's judgment or experience to pick samples. Here, the auditor might focus on high-risk, unusual, or large-value transactions. Example: in auditing expense claims, the auditor may decide to test only claims above $1 million or those approved by new managers. This saves time, but may introduce bias, because not every transaction had a fair chance of being selected. In short, Statistical sampling is objective, measurable, and data-driven. Non-statistical sampling is judgment-based, quicker, but potentially biased. Both methods are useful. Auditors choose the one that best fits the audit's goal, risk level, and available time. In auditing, it's often not practical to review every single record in a large population. For example, every payment, invoice, or transaction in a company. Instead, auditors use sampling, where a smaller group, sample, is tested to draw conclusions about the whole population. To make sure these conclusions are reliable, auditors use certain statistical terms, such as confidence level, risk, precision, and error rates, to measure how accurate their findings are. Let's break down these terms with real-life examples. 1. Confidence coefficient. This shows how confident the auditor is that the results from the sample represent the entire population. A 95% confidence level means the auditor believes the result will be right 95 times out of 100. Example: an IS auditor tests 100 payroll transactions and finds no errors. With 95% confidence, the auditor can say the whole payroll system is likely error-free. 2. Level of risk. This is the chance that the auditor's conclusion might be wrong. It's simply the opposite of the confidence level. If confidence is 95%, then the risk level is 5%. Example: if an auditor tests only a few transactions and assumes controls are working, there's a 5% risk they might miss a hidden error or fraud case. 3. Precision. Precision measures how close the sample results are likely to be to the true population result. Smaller variation means more precise results. Example: if an auditor finds that 4% of expense claims are wrong, with a precision of +1%, it means the true error rate for all expenses is likely between 3% and 5%. 4. Expected error rate. This is the number of errors the auditor expects to find before starting the test, based on past results or management input. Example: if last year's audit found that 2% of invoices were duplicated, the auditor might plan this year's testing expecting a similar 2% error rate. 5. Sample mean. This is the average of the sampled items. It helps estimate the average value of all transactions in the population. Example: if an auditor samples 5 travel reimbursements, $100K, $120K, $80K, $90K, and $110K, the sample mean is $100K. This gives a good estimate of what the average reimbursement looks like across the company. 6. Sample standard deviation. This shows how spread out or different the sample results are. If the sampled amounts are similar, the deviation is low. If they differ greatly, the deviation is high. Example: if payroll payments range from $90K to $100K, deviation is small. But if they range from $10K to $500K, deviation is large, meaning more samples may be needed to ensure accurate results. 7. Tolerable error rate. This is the maximum number of errors the auditor can accept before concluding that controls are weak or unreliable. Example: if management can accept up to 3% of minor payroll errors without major impact, that's the tolerable error rate. If the auditor finds 5% errors, the control has failed and corrective action is needed. 8. Population standard deviation. This measures how much all items in the entire population differ from each other. More variation means the auditor must test more samples for reliable results. Example: in a telecom company, customer bills may range from $1,000 to $10 million. Very large differences. This wide range means the population deviation is high, so the auditor must take a larger sample to draw valid conclusions. When auditors can't test every record in a company, they use sampling to check a small number of items and make conclusions about the whole population. The two main types are attribute sampling and variable sampling. Attribute sampling is used when the auditor wants to know if something meets a rule or not, a simple yes or no. It's mostly used in compliance or control testing. Example: An IS auditor wants to know if all employees who left the company had their system accounts disabled within 24 hours. The auditor randomly picks 50 user accounts and checks each one. If 45 were deactivated on time and 5 were not, that shows how well the control works. It's about checking compliance, not measuring amounts. Variable sampling, on the other hand, is used when auditors want to measure how much something is, like a value, quantity, or amount. It's mostly used in substantive testing to verify the accuracy of figures. Example: an auditor checks 30 customer invoices to confirm if the billed amounts match the goods delivered. Each invoice has a value: $50,000, $80,000, $120,000, and the auditor compares them to the accounting records to see if the totals are correct. This helps detect overstatement or understatement of financial data. In summary, attribute sampling checks if a control is followed. Variable sampling checks how accurate amounts are. Both help auditors form reliable conclusions without checking every single transaction. Attribute sampling deals with yes or no questions. It checks whether an item meets a condition or not. The data is usually grouped into categories like compliant or non-compliant. Auditors use counts and percentages to summarize results and may calculate confidence levels to estimate how reliable their findings are. Example: an IS auditor reviews 100 user access forms to see if they were approved by a manager before system access was granted. Out of 100, 92 were approved and 8 were not. The auditor calculates that 92% comply with policy and uses statistics to estimate how confident they are that this reflects the full population. Variable sampling, on the other hand, deals with numbers and amounts. It measures how much or how large something is. Here, auditors calculate averages, standard deviations, and confidence intervals to assess accuracy. Example: an auditor tests 40 vendor invoices to verify if the amounts billed match purchase orders. The auditor compares the recorded and actual costs, calculates the average difference, and uses statistics to estimate the total possible misstatement for all invoices. In summary, attribute sampling tests compliance or presence of a control, e.g., approval given, yes, no. Variable sampling tests accuracy of numerical data, e.g., is the amount correct? Both methods give auditors confidence that their conclusions about the larger dataset are valid without testing every single record.